Joining us now is Warren Pies, 314 Research co-founder, and David Lefkowitz, UBS Wealth Management Senior Equity Strategist. Good afternoon to you both. David, I'll start with you. You're saying 3,800 by the end of the year, but you think we could potentially go higher before we go lower. Break it down for me.
Yeah, sure. I think Morgan, what some of the issues that we're still worried about is that, look, the banks are tightening access to capital. The yield curve is inverted. The Fed's probably not going to be able to cut interest rates anytime soon. So, we still think there's going to be pressures on earnings growth in the quarters ahead, notwithstanding the fact that the most recent earnings season has been pretty good. So, we look at it more from a risk reward perspective is how I would approach it. In a true soft landing, stocks could rise another maybe 5%. I mean, I think we're pricing in a lot in terms of a soft landing. And if we slip into a recession, we certainly could see some more material downside, say 15 to 20%. So from that perspective, we think stocks are, not as appealing here, especially with, reasonable yields in fixed income.
Yeah, Warren, we've been talking about narrow breadth. I mean, when you see the rally you've seen today with the Dow leading the charge and the Russell 2000 up 3.4%. Are we looking at a breakout here? How do you think about it?
Well, how I'm thinking about it is this is what the bulls would want to see exactly from the breadth, honestly. And I've been pretty cautious on the market, but you have to honestly let the evidence guide you. And the way I interpret the market moves today is this is the big recession trade getting kind of priced out of the market. So we came into the year. The consensus was we were going to have a recession early in 2023. At 314, we always thought it was a second half 2023 event, which keeps us kind of cautious and in no man's land. We reran our model yesterday and issued a report yesterday after rerunning our housing model and getting some new data. And our conclusion is that basically this recession is drifting off into the distance and is most likely a Q1 2024 event. And every single data point, including the jobs data that came in today, is just pushing that recession out in the distance. So what this means is it's negative for bonds and stocks get a bid incrementally. And if you're going to buy the stock market here, you're going to need that bottom 490 stocks that we've been talking about to really do the heavy lifting. So those are cyclical sectors. Those are economically sensitive sectors and consumer driven sectors. That's what we saw today. So if you're a bull, this is what you want to see. I think you continue to get that rotation out of bonds. For us, I would rather play it through commodities, underweighting bonds and getting into commodities. I'm still going to run a max overweight on my cash position though, because cash is king in this environment.
Okay, sounds like we got a little disagreement here. Warren saying negative for bonds. David, you were just talking about fixed income and reasonable yields there. So how do you play fixed income safely here? There are expectations of a pause from the Fed coming up, but we just got that strong PCE number, a relatively strong jobs number. Is it just that interest rates aren't going much higher and that makes it relatively safe, or do you really have to watch out in bonds?
Yeah, no, I think we do think interest rates are going to be trending lower by the end of the year. Let's not forget that, the Fed is already well above its assessment of what neutral is. And I think that's going to keep an anchor on how high, even in a really benign outcome where we do have a soft landing and everything works out fine, I think that's going to keep a bit of an anchor in terms of how much rates are going to go higher because again, we're, the Fed is so much above neutral at the moment. So, the way we think about it is you can get a pretty good yield, and we're not really talking so much about, we're not so worried about the risk of yields going higher or rates going higher. And if inflation does fall, which we do think will happen, and growth slows down, yields could even go a little bit lower. So from that perspective, we think fixed income looks pretty attractive.